Hello students, this is Dr. Kapil Kapoor from Muradabad Institute of Technology, Muradabad, under the aegis of Dr. APJ Abdul Kalam Technical University, Lucknow. Today I welcome you all in the series of lectures of nature of debentures and bonds and their valuation. Now this section belongs to the subject of investment analysis and portfolio management. Now this section is a very interesting section in a manner that many investors, student, portfolio managers want to know that if suppose they have some savings to invest somewhere, what are the various alternatives that they can invest those savings in, and what are the various options available and how they can value them so that they can get a good return on their investments. So, in various sources of alternatives that are available to the investors, to to the portfolio managers, shares, debentures and other instruments are also there for investment purpose, and today we are taking those alternatives, and that alternative that I am taking with me today for the explanation of that is bond and debentures and how we can value them so that we can find out whether we are purchasing a right asset at the right price, so that the problem of undervaluation, overvaluation of the instrument does not arises, so that we can also get the return as desired by us. Now, so let's start the discussion. The first slide that we will be covering is the first slide that we will be covering is the nature of debenture and bonds. Debenture and bonds are financial instruments through which companies raise funds for long term needs. Now, an organization needs funds for long term as well as short term duration. For fulfilling the desire of long term duration, there are several instruments available in the market, and fulfilling the desire of short term funds, there are short term instruments available. For long term needs, for purchasing fixed assets, for long term investments, that there are several instruments in the financial market that are available, that are shares, debentures and long term loans that you can take from the bank. Debenture is one of those, and debenture and bonds are one of the financial instruments through which company raises funds for long term needs, and these long term needs are generally ranging from a year, more than a year, to 5 years, to 10 years and to 15 years, and a bond duration can go beyond 15 years also, it can be of 20 years also. The second point that we will be dealing is, it is a kind of a loan taken by a company from a general public. Now, what this point tells us? This point tells us that when a person purchases a bond, he becomes a creditor of the company. And if suppose a company is issuing bond to raise long term capital, long term funds, then the bond that they are raising, the funds that they are raising from, they become liable towards the bond holder to pay that amount, principal amounts, after the maturity of the bond. The third point is, they are fixed income securities, carry a coupon rate of interest. Now, one unique feature of bond and debenture is that they carry interest rate, they carry a fixed interest rate. The coupon rate and the word interest rate are same. The popular term that is being used in bond and debenture terminology is coupon rate. So, the fixed income securities, they generate fixed return. Year to year, the bond holder would get a specified amount of interest on a certain percentage which is fixed and generally mentioned on the bond. The fourth point, it is a legal document containing an acknowledgement of indebtedness by issuing company. Now, it is an instrument through which the company acknowledges that after certain period of time, the amount that they have borrowed from the bondholder, they will repay that amount back to them after the expiry of that period, after the maturity has completed. Now, the next point is, they can be secured or unsecured. Now, this is a very interesting point with regard to the features of bond and debenture. Here there is a word secured. What does secured word here means? Secured here means that bonds and debentures are secured. They have a charge. If suppose a company is issuing a secured bond or debenture, then they have a charge on a specific fixed asset. In case a company goes into liquidation, the bond holder will have a claim on those assets on which the company has put on charge. Now, there are unsecured debentures and bonds also, but unsecured means that they are the bond does not carry any specific charge on any fixed asset. These unsecured debenture or bonds are also called naked debentures or bond. Next point, provision of redemption and conversion. Another feature of bond and debenture is that there is a provision of redemption and conversion in the bond agreement. What does redemption here means? Redemption simply here means that after the expiry, after the maturity period, the principal amount will be repaid back to the bondholder. And conversion option here means, conversion means that while entering into the bond contract, while entering a legal agreement with the bondholder, there can be a clause that after a certain period of time, rather paying the full principal amount to the bondholder, the company can convert that amount into equity shares, equal number of equity shares. So that option is also there. The bonds and debentures can be converted into equity shares after a certain period of time, that is specified in the agreement. The next point is priority over a preference and equity shareholders. Now this point relates to the point of interest payment and principal payment. Now priority over preference and equity shareholder here means that if suppose I am a bondholder, I have a right of interest. The company is due to give me regular interest payment year on year basis, whether company is earning profit or not, it does not matter. The company has an obligation on them that they have to pay the interest to the bondholders. This is not the case in case of preference shares or equity share. Preference shares and equity shareholders get dividend, but that dividend is paid out of the profits of the company, and that too is not the right of preference shareholder and equity shareholders. So in this case, the bondholders get priority over the income returns in the form of interest. Whether company is earning profit or not, the company will have to pay interest to the bondholders. Similarly, after the maturity, the principal amount has to be repaid. And secondly, when the company goes into liquidation, the company is not in a proper financial condition, it goes into liquidation, then all the assets of the company will be sold out to wind up and set out the obligation that is on the company. In that case, the amount that the company get after selling out the assets, the bondholders have priority over the amount, and they will get that principal amount before the preference shareholders and the equity shareholders. And the last point of discussion regarding the features of bond and debenture is interest is tax deductible expenses for company. Now this is a very good advantage for the company who are issuing bonds. Interest is deductible as an expense item from the profits of the company, which reduces the tax liability of the company. So there is a tax advantage for the company if suppose they are issuing bonds. So and this is an advantage over preference shareholder and equity shareholder. Suppose the company is raising funds to preference and equity shareholders, dividend is not tax deductible. So the tax advantage or tax shield that the company get from issuing the bonds is this point. Now let's before moving on to the next point, there is a lot of confusion among the student. Sir, there is any difference between the bond and debenture, because these two some are used interchangeably. Now to be very frank, there is a slight difference between the word debenture and bond, and that difference arises from the issuing body. Generally in India, bonds are being issued by the government agencies, central government, state government and corporation and big financial corporate institution, while debenture are being used by corporate houses, private companies, those who go for in public to raise funds. Another feature is that in worldwide there is in US especially, in US what happens, bonds is taken to be an instrument of debt which is secured, and debentures are taken to be instrument which are generally unsecured. Now these are the small distinctions that are there between bond and debenture. Otherwise all the properties that they are in the bonds are there in the debenture, they are almost similar. In case of interest rate, it can happen that the bond interest rate might be on a lower side in comparison to the debenture interest offered by the companies. Now we move on to the next slide. Valuation of debenture and bonds. Valuation of debenture and bonds. Now here we see how we can value debenture and bonds and why valuation is necessary from the perspective of the investor. Valuation is necessary from the perspective of the investor so that he can actually identify whether he is purchasing the asset at the right price or not. Either he can purchase that asset at overvalued prices or undervalued prices. This matters significantly because if the bondholder purchases a debenture or bond at incorrect prices, the returns that they will get will be reduced. Now see the definition. Value of debenture and bond is always from the perspective of an investor. Now the word perspective of an investor is very important here. What does perspective of an investor here means? perspective is subjective matter. It changes from investors to investor. How I as a person look at an investment instrument will be a different outlook to another investor. So, for a same bond, say suppose a company issue a bond X, there are two people A and B, they might have different perspective for this bond. The risk perception of A might be different and the risk perception of B might be different for the same kind of for the same bond. This is actually known as the perspective of the investor. So, when we try to calculate the value of the bond, the perspective of the investor matters, and the value is actually a subjective matter of discussion. It can be different values for different investor depending what is their risk perception, what their expected return is. Next is, it is worth of the debenture or bond as a perceived by an investor in present time. In more refined terms, it is the present value of all future cash inflows discounted at investors required rate of return. Now, this point is very important because here a very important term has come, discounted at investors required rate of return. This required rate of return is generally the interest expected by the or return expected by the bondholders, the yield expected by the bondholders, and this return is different to different investors. Different investor will have different discounting rates to get the present value of future cash inflows. Now, future cash inflows, what does future cash inflows here means? Future cash inflows in case of bond means interest payments and principal payment that the bondholder will get through the life of the bond, through the maturity of the bond. Interest he will get regularly, year wise year, or say compoundly, and then the principal amount which the bondholder get at the maturity of the bond period. Valuation of debenture can be done from the following classification. Now, to value bonds, there are several different classification available, and these classification can be redeemable debentures, deep discount debenture bonds, non-redeemable debenture bonds, convertible debenture and bonds. Now, I will be sharing the details of these things in the next slides. Let's move on to the next slide. Valuation of redeemable debenture and bond. First, before going into the details of the valuation of bonds, we will first discuss the concept of redeemable debenture and bonds. What is the meaning of redeemable debenture and bonds? Redeemable debenture simply means that the bondholder will get his money after maturity period. The company has an obligation to repay the principal amount that they have borrowed from the bondholder. So, that redemption period can be depends on the maturity of the bond. It can be 1 year, it can be 5 year, it can be 7 year, it can be 10 year, it can be 15 years, and it can go beyond 15 years also. So, after the completion of the maturity period, the bondholder get the money from the company has to repay back the principal amount. That is why these bonds are called redeemable debenture or bonds. Now, how to value redeemable debenture and bond? Let us discuss this thing. Value of redeemable bond is the present value of all cash inflows. Cash inflows we have just discussed in the previous slide. Cash inflows are the interest payment that you get annually and the principal amount that you will get after the maturity of the bond period till the date of the maturity. Now, see, the simple formula for calculating the value of the bond is written here. Now, we will be discussing the various variables that are there which can be discussed for valuation of the bond. Here VD stands for value of debenture and bonds. I here stands for interest amount per annum, the interest that is fixed and the bondholder gets annually. PVIFARN means present value interest factor for an annuity at nth period. Now, there are very important terms that are coming out in this discussion. The first term is that present value interest factor of an annuity. Present value tables are available in financial management books where you can find these present value at a specific rate of percentage for a certain period of time. Now, you can use those tables for finding out the present value, and here the word annuity is being used. Annuity is being used in reference to interest that you will get annually till the maturity of the bond. That is why the word annuity is being used. Now, the second next term is PVIF, present value interest factor for single amount at R for n period. R here means rate expected return by the investor or discount rate, and N here means maturity period, duration till the debenture is hold. Now this maturity period depends on when the bondholder is purchasing then bought from the market. It can be the full length of the period, right from time 0 to the full 15 years. Say a bond is of 15 years maturity, a bondholder can purchase at the time at time 0 and it can go back to 15. Now any other investor can purchase this bond in the secondary market, say in 5 years. So then the maturity period will be of 10 years. Now we shall move to next slide. Now there is an example given here to understand the concept of valuation of bonds. The example is a 10% rupees 100 face value debenture having a provision for redemption at a premium of 5% at the end of 5 years is being traded in the market from the very first day of the issue. An investor has expected rate of return of 12%. At what price the investor should buy this debenture? Now the problem is very simple. The question is asking you to value the bond. How we can correctly find out what is the intrinsic value of the bond? By using the present value formula, by using the formula for calculation of the bond. Now you can see the face value is and the interest rate is 10%. It means that annually the person will get 10 rupees as interest. The maturity period, the N here is 5 years, and discount rate, that is the rate of discount, the rate expected rate of the discount holder is given in the caution, that is 12%. Now through the very formula that we have discussed, that the bond holder will get this interest annually throughout the life of the bond, which stands at 5 years, and the discount rate that the bond holder is expecting is 12. Similarly, at the end of the maturity value will be received by the bond holder, and the PVI table will be used at the 12 years at 12% and 5 years. Now see here, 10 is the interest rate, and this is the present value factor of present value factor for 12% at number of years of 5 maturity, and this is 105 because it is expected that the bond will be redeemed at 5% value, 5% premium. It means at the redemption the bond holder will get 105 at the time of maturity. So 105 multiplied by the present value factor will come out to be 9559. Now 9559 is actually the intrinsic value that is calculated by the investors, and this value actually specify that the bond holder should not be paying more than this value. If suppose the market price of the bond, if the market price of the bond is right now 100, if the market price at current rate is 100, then the intrinsic value that is coming out is 95.59. This means the bond holder should not invest because the bond is overvalued right now. Now if suppose the price of the market price of the bond is 95.59 or say suppose less than this, it means that the bond is undervalued and the investor can buy this bond or can hold this bond and it will actually increase its return. So correct valuation can be identified through these formulas for valuing the bonds. Now a student must be thinking, is there any other formula? If suppose they do not have present value interest factor tables available with them, can they use any other formula for calculating the valuation of bonds? So then there is a formula which student can adopt for calculation of value of the bonds, and that formula is I, that is the interest, divided by 1 plus R to the power n plus m, that is the amount that the bond holder would get at the maturity, divided by 1 plus R to the power n. Now just say suppose this is the caution and we can use these same variables here. Now point is that interest the bond holder would get yearly for 5 years. Now how can we expand this formula? Very simple. The interest will be for the first year will be 10, rate is 12, and number is 1, that is the 1 year. This is the first year we will be discounting it, and the second year what will happen? Same thing will happen, only the value will change for the number of years. The discounting will be for 2 years. Similarly 10, 1 plus for 3 years and so on till 5th year, and in 5th year the bond holder will also get the maturity value, which is 105 divided by 1 plus 1.2 to the power 5. Now you can see here the year have matured, maturity has done, and the value has come out to 95.59. Now we move on to next slide, valuation of deep discount bond. What are deep discount bond? Deep discount bonds are the bonds which are issued at discount to the face value, at discount to the face value. Now what does this mean? It can mean that suppose the face value of the bond is 100, then deep discount bond, if company is issuing, company can issue that bond at 80 rupees. It means there will be a discount at the time of issue of the bond. Now in such cases, when the deep discount bonds are being issued, the company does not pay interest on it because they are already issued at discount to the bond holders. So how can we value these bonds which are issued at deep discount? These bond value can be calculated by a very simple formula. Now you can see there is a slight change from the previous formula of redeemable bond to this one. Here we are only getting the maturity value, and which is multiplied by the present value factor at R and N. R is the rate of interest or the discount rate for number of years. Now let's see a second example of it. A deep discount bond of rupees 1000 is being issued at a discount of 50% to face value to be redeemed at the end of 5th year. Investor required rate of return is 10% per annum. At what price he should buy it? Now we can apply a very simple formula here. VD stands for the face value of the bond was 1000. It means at the maturity time the bond holder will get the 1000 rupees, and it is being issued at discount of 50%. So it means at what price the bond will be issued? It will be issued at price of 500. Because it is being issued at discount of 50%. Now how can we identify, say suppose we want to find out what should be the current intrinsic price of the bond, so that the bond holder can correctly buy this bond at an appropriate rate. Now if suppose we apply this concept, 10% of a discount rate, that is the return that is expected, and 5 is the maturity, the present value of interest factor will come out to 6.21. Now if we multiply 1000 rupees, that the maturity value that the bond holder is getting, that is the face value in case of deep discount bond, we multiplied by the discount factor, the value that is coming out is 621. Now what does this imply? Now the bond is being issued at discount of 500, and the maximum amount that the bond holder should give should not be more than 621 rupees, 621 rupees, if his discount or expected return is 10%. Obviously these intrinsic value changes with this rate of return changing. If suppose anybody is having 15% rate of discounting factor, then this value change. Now 0.621 here means if the bond holder should not pay more than 621 rupees in the market for purchasing this bond. If suppose he does that, his yield will decline and overall return will decline on his investment. So that will work out to the disadvantage of the bond holder. Now the second valuation of non-redeemable debenture. Now the concept of non-redeemable debenture is that the the principal amount is never repaid back to the bond holder. If the principal amount is never repaid back to the bond holder, in such cases the bond holder only get the interest payment on it annually. So then the formula becomes very simple here. VD is equal to I divided by R to the N. VD stands for value of debenture, I interest amount to be received every year, and investors expected return, that is the discount rate that we are talking about in our discussion. Now see here, an example is given. A company has issued debenture with a coupon rate of 10% per annum. The face value of these debenture is 100, and investor expected rate of return is 12%. Now the discount rate, the expected return is 12% per annum. These debentures are available in the market at 105. The current market price prevailing in the market, in secondary markets right now, 105. Now the question is whether he should buy it or not. The formula was very simple. I divided by I stand for the interest rate that the bondholder will get, and that interest will be 10% of this 100 rupees of the face value. Now we will be dividing this I to the percentage, and the amount that we will get 83.33. Now we can compare here 83.33 is the intrinsic value that we are getting. Now we are comparing this intrinsic value with the market price that is currently prevailing in the market, and that market price is 105. Now the question arises that whether the bondholder should purchase this thing or not. Actually the current market price is far above than the intrinsic value that the bondholder is getting here. It means currently the bond is overvalued. If suppose somebody buys at 105, he will be at disadvantage. The overall yield on the investment that he is getting till the maturity is left will be declining, and suppose the investor is paying 83.33 or less amount than that in the market, then his investment, his decision will be justified, because at this prices or prices below this price, the return, the yield that the bondholder will get till the maturity will be maximized. Now next, value of convertible debenture and bonds. Now the discussion of value of convertible debenture and bonds. What are convertible debenture and bonds? First we shall discuss this. Convertible debenture and bonds are bonds or debenture which have the option of converting them into fixed amount of equity shares after certain period of time. That is in the maturity period. After the maturity period, the company can give the option to the bondholders that these shares, these bonds will be converted into number of equity shares. Now the formula for this is VD is equal to I PVIF and M multiplied by PVIF RN. This is the same formula that is there for the redeemable bonds. Now the question, see how the question is given here. A 9% of rupees 100 face value bond debenture having a provision of conversion at 5 years. It means after the 5 years, after the maturity of the 5 years or the amount specified in the agreement, the company can convert those bonds into equity shares, 4 equity shares of face value of rupees 10 each at a premium of 15 each. It is expected that the equity shares will have market value of 33 per share. This means at the completion of 5th year, the bondholder is expecting, or they can expect, that the market rate of per equity share will be 33 rupees at date of conversion. An investor is expected the rate of return is 15%. R is 15% here, discount rate is 15% here. Suggest him at what price he should be ready to buy this debenture. Now see, the formula is given here for the calculation of value of debenture bonds of a convertible debenture. Now you can clearly see the interest that the bondholder is getting is 9 rupees because the rate was 9%, and PVIF stands for 15%, 5 years, the value comes out to be 3.33, and PVIF value is 14.9. If we calculate this thing in this formula, the value of the bond will come out to 95.78. Hence 97.5 is the maximum value the investor can pay for this bond. If the bond value is less than this, then the return will be fine. If the bond value in the market is more than this, then it can be called a overvalued bond. Now I wind up this lecture. And I hope that the concept of characteristic of bond and debentures are fine with you, and you can value correctly the bonds. Thank you very much.